Okay, in this video, we are going to calculate cash provided from operations using the direct method, right? So rather than starting with net income where the indirect method used, the direct method is just going to add up all the cash that we receive, and then it's going to subtract all the cash payments. Under the direct method, the cash that we receive, boy, this is a terrible looking, it's not terrible, but it's hard to see. We're going to start with cash that we collect. And so we're going to get cash from customers. If I'm a rental agency or if I own property and I rent that property, then we would get cash from renters. If I had investments in some subsidiary and that subsidiary paid us interest and the cash was received in the form of interest payments, then I would treat that as cash. And then dividends that I received related to investments that I'm holding, all four of those would be sources of cash. Alternatively, we have payments of cash, operating payments we want to keep in mind. And so we have suppliers. So again, if I'm selling t-shirts and I'm buying those t-shirts from a t-shirt making company, then I would subtract that in the cash flow statement in the operating activities section. If I'm paying my employees cash, I would subtract that from the operating section. There's miscellaneous things that we would pay for running our business. It could be a whole host of things. It could be advertising, you name it. Right? But then if I pay interest, remember we were saying in the previous video that interest payments related to debt would be treated as cash payments or uses of cash in the statement of cash flows in the operating section. And then if I pay taxes, that's going to be another use of cash. The difference is going to be cash provided from operations. So it may seem like it's different, but it's actually the exact same approach. And so the indirect method, we started with net income, and then we made all of these different changes. One of them being depreciation. You will note when we get down to payments, there's no deduction, or I should say, no addition to account for non-cash transactions like depreciation, because we're sort of starting from ground up. We're saying, let's just quantify all of the cash payments. And so there's nothing to unwind since we're not starting with net income. So anyway, these are the four or five, I should say, ways that we are going to generate cash. So the obvious one is sales. So if I'm selling t-shirts, how much cash am I going to generate selling t-shirts? So what this slide is telling us is that we are going to start with pulling sales revenue from the income statement. That will be step one. And then the second step is going to be adjustments from the balance sheet, right? So if I'm looking at the balance sheet and I have a decrease in accounts receivable, then I'm going to treat that as an addition to my sales revenue. And it feels like it makes sense, right? We talked about it when we were talking about the indirect method. A decrease to accounts receivable means that some previous customers that owed us money are paying us in this period. And that's not revenue, right? So we recognize the revenue in some previous period. However, they're now choosing to pay us in this period. So we're just collecting cash. So what we're going to want to do is we're going to want to say, okay, let's start with sales revenue, and then we would add the decrease to accounts receivable, because all we're wanting to do is identify total cash, okay? And then the opposite's true. If there is an increase in my accounts receivable, then it means some of the sales that I made this period were made on account. And if I'm making sales on account, that's not cash. So I would have to subtract any increases in accounts receivable from sales revenue in order to determine cash provided from sales. Okay? Rent, interest revenue, and dividend revenue are all going to be the same concept. I'm going to start with the amounts reported in the income statement. Then I'm going to go look to changes in the balance sheet. And the general rule is if a current asset declines, that is a source of cash. And if a current asset goes down, goes up, that is a use of cash. Right? If my accounts receivable goes up, use of cash. If my rents receivable goes up, use of cash. Interest receivable, dividends revenue, all of those things are uses of cash. And then we liquidate current assets, and that generates cash. Okay? So then we can move down to the slightly more complicated ones, cost of goods sold. Okay? So payments that we make to suppliers, right? The first one. So I'm clearly going to start with cost of goods sold on the income statement. And then I'm going to make two adjustments, right? There's two balance sheet accounts that relate to cost of goods sold. The first one is inventory, and then the second one is accounts payable, right? So again, if my inventory goes up, it means I'm using more cash, okay? So again, I'm going to start with cost of goods sold, and then if my inventory goes up, I'm going to add more uses of cash. Cost of goods sold is a use of cash. And so if I'm buying more than I need in terms of inventory, purchasing more inventory is just going to be a continued use of cash. And then alternatively, if my inventory goes down, then I am essentially selling t-shirts that I didn't have to pay for in this period. So it would be a decline in my inventory would be a source of cash. It's a subtraction to an expense. It's kind of hard to picture. But I think if you just follow the formula, you should be okay. Cost of goods sold, and then you plus or minus our changes in inventory. Then we also have to look at accounts payable, right? So if my accounts payable went up, then we're saying we purchased inventory without having to pay for it. And that would be a secondary use of cash, a secondary source of cash. And then if my accounts payable goes down, the only way that it's going to go down is if my accounts payable goes up, then that is a source of cash. Very hard to articulate. But we're saying if my accounts payable goes up, that is like a source of cash. And we're saying that since it's a source of cash and cost of goods sold is a use of cash, then we would subtract an increase in accounts payable from cost of goods sold. Kind of hard. But again, there are two paths. One where you're trying to understand what's going on, and the other one where it's the last fucking video of this book. And so just give you the formula and use the formula and you'll be totally fine. Okay, all the rest of them are the same. Operating expenses, okay. Again, this is a use of cash on the income statement. And then if my prepaids goes up, if there is an increase in my prepaids, it means I'm paying more. I'm paying in advance. And if I'm paying in advance, that is a use of cash, okay? And then alternatively, if my prepaids goes down, right? If my prepaids goes down, man, I'm killing myself. An increase in prepaids, yes, is a source of cash. And then a decrease in prepaids is a use of cash. Okay, one more time. An increase in prepaids is a use of cash. A decrease in prepaids as an increase or a source of cash, right? If I am lowering my prepaids, it means that I am receiving something without paying for it, and therefore it is a source of cash. What gets me tripped up every time are the pluses and minuses. So again, we are saying we are increasing the use of cash. And here we're saying we are decreasing the use of cash. And then accrued liabilities. A decrease in accrued liability is a use of cash, right? So a decrease in accrued liabilities, right? So we owed somebody money, and if that goes down, theoretically we're using our cash, and so we would be treating it as a use of cash. An increase in accrued liability is a source of cash, right? So we are going to lower this expense. And then salaries payable, wages, interest, and income taxes are all relatively straightforward. And that, my friends, is financial accounting.